Thousands of American retirees are losing substantial amounts of money to the Internal Revenue Service each year, not because they've done anything wrong, but simply because they were never properly informed about a critical tax rule involving home sales. These are people who've lived in their homes for decades, raised their families within those walls, and paid off their mortgages years ago. When they finally decide to sell, they're blindsided by tax bills they never anticipated. The most frustrating aspect of this situation is that these tax liabilities are often completely avoidable with the right knowledge and planning. For anyone who is currently retired, approaching retirement age, or simply planning ahead for the eventual sale of their home, understanding this particular tax rule could prove more financially beneficial than almost any investment strategy. Missing even a single critical detail in this area can result in losing tens of thousands of dollars that could otherwise remain in your pocket. Many retirees operate under the assumption that once they stop working, their tax situation becomes simpler and less burdensome, particularly regarding their primary residence. There's a widespread belief that a home becomes automatically tax-free after you've lived in it for many years, especially if you've raised your family there and completely paid off the mortgage. This belief seems entirely logical, and for generations, people have repeated it without questioning its accuracy. However, the reality is that the IRS maintains very specific regulations about what happens when you sell your home, and a significant number of retirees don't fully grasp these rules until it's too late. This gap in understanding can sometimes cost people tens of thousands of dollars, or at minimum, create shocking tax obligations they never saw coming. The regulation that creates the most confusion among retirees relates to capital gains tax on home sales. Capital gains is simply the term for profit you realize when you sell something for more than you originally paid for it. If you purchased your home many years ago at a relatively low price and sell it today for a substantially higher amount, the difference between those two figures is considered a gain. The IRS typically taxes such gains, but there exists a special provision for primary residences that can protect a significant portion of that profit. This is precisely where many retirees hear only part of the story, not the complete picture. Under current IRS regulations, when you sell your main home, you may qualify to exclude or completely avoid paying tax on a substantial amount of your profit. For single filers, the IRS permits you to exclude up to $250,000 of profit from taxation. For married couples filing jointly, that figure increases to $500,000. This sounds extraordinarily generous, and in many situations, it genuinely is. For retirees who purchased modest homes years ago and sell them for reasonable gains, this exclusion can mean paying absolutely no federal tax on the sale. However, this exclusion is neither automatic nor unlimited. The IRS establishes clear conditions that must be satisfied before you qualify. One of the most significant requirements is that the home must have been your primary residence. This means it must be the place where you actually lived most of the time, not simply a property you owned. The IRS examines where you received mail, where you were registered to vote, where your driver's license lists your address, and where you spent the majority of your time. Another crucial condition is the timing requirement, commonly referred to as the 2 out of 5 year rule. To qualify for the exclusion, you must have both owned the home and lived in it as your main residence for at least 2 years during the 5-year period before the sale. Those 2 years don't need to be consecutive. but they must total at least 24 months. This is where many retirees accidentally violate the rule without realizing it. Consider this common scenario. Some retirees move into a smaller residence, relocate to live with family members, or move to another state for health reasons. They may retain ownership of their original home for several years before deciding to sell it. By the time the sale occurs, more than 3 years may have elapsed since they actually resided there. Even though they owned the home for decades, they no longer meet the 2 out of 5 year requirement. When this happens, the exclusion may no longer be available, and the IRS may treat the entire profit as taxable income. Another issue that surprises retirees is the extent to which their homes have appreciated in value. Many people purchased their homes in the 1980s or 1990s at prices that now seem incredibly low. A house bought for $100,000 decades ago might sell today for $600,000 or $700,000 or even more in certain markets. While the exclusion covers a substantial portion, it doesn't cover everything if the profit exceeds the permitted limit. Let's examine a specific example. Suppose a married couple purchased their home for $150,000 and sells it for $800,000. That represents a profit of $650,000. The IRS allows them to exclude up to $500,000, but the remaining $150,000 may be subject to capital gains tax. Many retirees assume the entire sale is tax-free and are shocked to discover that a portion may still be taxed. Another aspect retirees frequently misunderstand is the difference between purchase price and taxable profit. The IRS doesn't simply look at what you paid for the house and what you sold it for. There's something called cost basis, which is the starting value used to calculate gain. Your cost basis usually begins with the price you paid for the home, but it can increase over time if you made major improvements. This is an area where many retirees miss opportunities for tax savings simply because they didn't maintain proper records. Major home improvements, such as adding a room, remodeling a kitchen, replacing a roof, or upgrading plumbing or electrical systems, can increase your cost basis. This means the IRS recognizes your investment in the home as higher, which reduces your taxable gain. Unfortunately, many retirees don't keep receipts or documentation for improvements made decades ago. Without proof, those costs cannot be added to the basis, and the taxable gain appears larger than it should be. There's also confusion about what qualifies as an improvement versus a repair. Routine maintenance, like painting, fixing a leak, or replacing a broken appliance, usually doesn't count. Improvements are changes that add value to the home, extend its useful life, or adapt it to new purposes. Understanding this distinction can make a significant difference in how much tax you owe when you sell. Another situation that often catches retirees unprepared involves second homes and vacation properties. Some people assume the same exclusion applies automatically, but that's incorrect. The exclusion only applies to your primary residence. A vacation home, rental property, or investment property doesn't qualify unless specific steps are taken. However, there is a strategy that some retirees can employ with careful planning. If a retiree owns a vacation home and decides to make it their primary residence, they may be able to qualify for a partial exclusion. This requires actually living in the home as the main residence and meeting the 2 out of 5 year rule before selling. Even then, the IRS may prorate the exclusion based on how long the home was used as a primary residence versus a rental or vacation property. Another overlooked factor is how selling a home affects other taxes. Even if part of the profit is excluded, the taxable portion can increase your overall income for the year. This can push you into a higher tax bracket, increase taxes on Social Security benefits, or raise Medicare premiums. Retirees often focus exclusively on the home sale tax itself and forget how it interacts with the rest of their financial picture. Timing also plays a crucial role. Selling in a year when your income is lower can reduce the tax rate applied to any taxable gain. For example, if you recently retired and your income dropped compared to your working years, selling after retirement might result in lower taxes. Conversely, selling during a year with high income from pensions, required minimum distributions, or other sources may increase your tax burden. Another important detail is that the exclusion isn't something you can use unlimited times. While it's possible to use it more than once in your lifetime, you generally cannot use it more than once every 2 years. This matters for retirees who move frequently or sell and buy homes within short periods. Divorce and the death of a spouse can also affect how the exclusion applies. In some cases, a surviving spouse may still qualify for the higher $500,000 exclusion if the home is sold within a certain time after the spouse's death and other conditions are met. These rules are complex and often misunderstood during emotionally difficult times, which makes advanced planning critically important. Many retirees assume the IRS will automatically apply the exclusion correctly, but mistakes can happen, especially if paperwork is incomplete or inaccurate. It's important to report the sale properly, even if no tax is owed. Failing to do so can trigger correspondence from the IRS, delays, or penalties. The biggest takeaway for retirees is that selling a home isn't merely a real estate decision, it's also a major tax event. Understanding the rules ahead of time allows people to make better decisions, avoid surprises, and keep more of their hard-earned money. Financial advisors and tax professionals often recommend reviewing home sale plans years in advance, not months. Knowing when to sell, how long to live in the home, what records to keep, and how the sale fits into overall retirement income can make a dramatic difference. For many retirees, their home represents their largest asset. Treating its sale casually or assuming it's completely tax-free can be a costly mistake. The IRS rules aren't designed to punish retirees, but they are very specific, and ignoring the details doesn't make them disappear. Understanding this critical IRS home tax rule, and more importantly, understanding the fine print behind it, can mean the difference between a smooth, stress-free sale and an unpleasant financial surprise. With the right knowledge, retirees can make informed choices, protect their savings, and enjoy their retirement with fewer worries and greater peace of mind.